It's a real pleasure to have with us Lauren Templeton and Scott Phillips of Lauren Templeton Capital Management. Welcome.
Thank you.
Thanks.
I'm really excited to learn about your approach that's been proven over time and by the great Sir John Templeton. And perhaps before we get into all that, I'd love to hear a bit about your background and how you got interested in investing.
Sure. I grew up in the investment industry, but my dad is the first person who made me very passionate about investing. So when I was 7, he started allowing me to pick one stock per month. He would take the stock certificate and he would hang it on the wall of my bedroom. So my bedroom walls were wallpapered in stock certificates, and he put me to bed with stories about the magic of compounding. There was never a doubt in my mind that I wouldn't go to work in the investment industry. And I did that upon graduating from college, And Sir John, who's my great uncle, seeded my first hedge fund in 2001 with $30 million when I was 24 years old. So that's how I got my start. It was kind of, I was thrown in the swimming pool, and I've been swimming ever since.
And Scott, perhaps you could tell us how you came to the firm?
Sure. Well, again, early on, it was under the heavy influence of my father-in-law, Lauren's father. He encouraged me to take a look at investing as a career, and I did. And for about 5 years, I worked on the sell side as a junior analyst covering stocks for a firm called Robinson Humphrey. It's owned by SunTrust Bank in Atlanta, Georgia. And I did that for about 5 years and was very interested in the analytical side of the process and learning more about that. And I think it was probably around the time that I picked up a copy of Security Analysis by Ben Graham and began studying more closely some of the concepts of value investing and how that applied to the industry overall, and really discovered that a large amount of the attention that was focused on stocks on the sell side that we were covering ignored probably the better bargains and opportunities in the market. And from there I went and worked as a buy-side analyst with a firm called Green Key Asset Management in Nassau, Bahamas. It's run by a lady named Jane Siebels, and she was a Templeton protege. She was the first female portfolio manager at Sir John's old firm before he sold to Franklin Resources. And around the time that Lauren and I got engaged and became married, that's when I came over and joined Lauren at her firm as a portfolio manager, and that was under the heavy influence of Sir John as well that we consolidate our interest and work together. So.
And Sir John Templeton, obviously a great teacher to all of us. I'm curious just to understand a bit what your key takeaways were and what are the guiding principles for your firm.
Well, Uncle John always had a nameplate on his desk that said trouble is opportunity. And we actually have that phrase on our front door of our office. That's how he viewed the markets as trouble is opportunity. When there's volatility in the markets, that's a great opportunity to pick up a bargain and compound money at a higher rate of return than the next guy. He was very calm and disciplined in his investment approach and applying his value investing techniques across a variety of markets. As you know, he pioneered global investing. So he was investing in Japan in the 40s and 50s and diversifying money outside of the United States, which was very uncommon during that time period. And that has influenced our style very greatly. We are global value investors. We believe that you need your largest universe of stocks possible to find value opportunities. And so we search the globe for the best opportunities.
And I would only add to that, like Sir John, we're very valuation-led. So our search is exclusively on the best bargains, and we'll chase them down wherever we can find them.
And what have been areas or your favorite hunting grounds? More recently, we have the crisis in Europe. Japan's been cheap for a very long time. Where do you like to look for opportunities, or what type of opportunities attract you?
They're really everywhere. We don't pick a region and say, let's go focus on Japan and find bargain opportunities there. We run valuation screens, and we focus on the bottom decile of those screens. And if you run these screens on a daily basis like we have for the past decade, you'll see the same stocks that occur on the screens every day. Those are the value traps. Occasionally you'll see something new. Right now we really like the theme of the emerging market consumer. I think that's a very long-term theme that investors need to be focused on. It is an amazing opportunity. And any type of market volatility is an opportunity to buy the emerging market consumer at a better price. So for instance, during the financial crisis, we were really focused on many of the ag stocks. The idea that as per capita income grows in the emerging markets, people eat a little bit better, consume a little more protein. To have more protein, you need more grains. To grow more grains, you need more fertilizer. You need more farming equipment. And those were really highly profitable positions for us. We've liquidated a good number of those because they're now trading at fair value. During the European financial crisis, which we're still living, we bought stocks like Richemont, which is a luxury watch manufacturer. They make brands like Baume, Mercier. The emerging market consumer's appetite for luxury goods is very large. The average man in China has 6 watches, I think, as opposed to in the U.S. where most people just have 1 watch. So our opportunity, we're agnostic to region and country. We look for opportunities everywhere, but most of them tend to be tied back to the emerging market consumer. We think that there are 2 ways to find a bargain. You can either find a neglected stock, which has little analyst coverage, or you can invest on the heels of a crisis or a panic. So those are the 2 mechanisms we use to find bargains.
And I guess that this trend of the emerging consumer in places like China and India, a lot of investors would say that the best way to play this is to buy the big brands, the US listed companies or Western Europe listed companies, but they don't really get that cheap. Do you look for local brands, small companies in local markets?
We do both. We invest in the best bargain. If that happens to be a big multinational, then we'll invest there. If it's local shares, we'll invest there. So we really invest both ways.
Yeah. And, you know, most often, as you said, the cat's kind of out of the bag with the emerging market consumer. A lot of people have caught on to it. But if you go back to August and September of last year, in 2011, a lot of those stocks traded down significantly, and they could have been had at a bargain at that point in time. But the discount closes very quickly when people kind of, you know, calm down a little bit, so to speak. So I think to grab those bargains and those large names that everyone's familiar with, you really have to be ready to pounce during panics and crises.
And Lauren, you've written a wonderful book, Investing the Templeton Way. I'm just curious if you could share with our viewers some of the things in the book, some of the areas that we can all learn from, and maybe you think that may be underappreciated, what Sir John Templeton was preaching and practicing.
Well, Investing the Templeton Way was really a research project that we did at our company. And then we had the opportunity to turn it into a book. But what we decided to do is research some of his well-known trades throughout his career. And what I wanted was the historical context that the trade occurred. We read all of his letters and reports surrounding those trades. I really wanted to put myself in the frame of mind where I understood the context for his investment decision. And so what the book does is profile 10 of his most famous trades and puts those trades into historical context. So for instance, we talk about his famous first trade, buying at the point of maximum pessimism, where he invested $10,000 on the eve of World War II in 104 companies trading on U.S. stock exchanges. 37 were in bankruptcy at the time. And ultimately, all of those companies were profitable except for 4, and he turned the $10,000 into $40,000. But we wanted to look at why he made those decisions. What people don't know about that trade is that he was actually investing in high-cost operators, which is something most people would never imagine.
That's right. I mean, most often he would go for quality, akin to Warren Buffett or any other value investor. But in that specific situation, he was flexible enough to look at the simple fact that those were the best bargains at the time. And part of that reason was he was looking for the economic benefits of World War II, the rise in industrial production, and the effect that would have on the highest cost operators in the market who were near or in bankruptcy. And the second factor was if you had gone out and bought the high quality firms that had continuously made profits through the 30s, a lot of their profits would have been clipped by the excess tax on wartime profits. And these firms that had been generating losses had the loss carry forwards and were never affected by that. So those were the stocks that stood to benefit the most. So it was that flexibility to look at that specific situation and find the best bargain that I think was key. And he just demonstrated it over and over again throughout his career. I mean, he was a global investor, but if you look at 1982, for instance, the death of equities period, when no one would touch U.S. stocks, he had nearly 70% of the Templeton Growth Fund in those stocks, U.S.-based companies, because they were the best bargains on replacement value. So he was always flexible enough to just go and find that bargain wherever it was.
Yeah, and we have chapters on his investments in Japan in the 40s and 50s, and in South Korea post the Asian financial crisis. And reading and researching those chapters, we saw what he saw in Japan, what he saw in South Korea, so that now we will be able to identify that in other countries during our investment lifetimes. I mean, his investments in Japan in the 40s and 50s were so early. There were capital controls. You couldn't convert the yen to the dollar. He was confident that those capital controls would be reduced. Eventually, he was confident enough to start investing his client money into Japan. But he was very early there, and he saw a lot of the same characteristics that he saw in Japan. He saw in South Korea, and it enabled him to invest in South Korea on the heels of the Asian financial crisis. So I think investors can learn a lot by reading about his historical trades. It is an interesting book.
Yeah. Now I would say in the present day, Sir John rode the Japanese phenomenon for 30 years in this fund, and we look at the emerging market consumer today in a similar light. We're content to, continue to exploit this theme over the next 20, 30 years because it probably has that much firepower behind it, even notwithstanding cyclical collapses like the real estate bubble in China and so on and so on. So we'll try to seek to take advantage of volatility as it occurs in those probable events over time.
And I'm just curious to understand, have you explored the motivation of Sir John Templeton to go abroad, to go to all these markets that nobody else did? Why did he do that?
That's a complex question. First, I've done a lot of research on his childhood environment. His parents played a large part in the way he saw the world. His mother, who is my great-great-grandmother, was college educated in the early 1900s in the rural South. It was very unusual. She traveled by herself as a young woman to Texas to be a tutor at the Kennedy Ranch in Texas. She funded a missionary in China in the early 1900s. You can tell when you read about Sir John's childhood that his mother had this very global view of the world. They traveled a lot as young children. She would put them in a car and drive to Florida from Tennessee. This was a big deal during that time period. The car tires would blow out every few miles. They would change
Camped on the side of the road. There were no hotels.
The map wasn't like the maps we have now. It was called a blue book, and the blue book would say, go to this person's farm and turn right at this fence post and knock on the farmer's door and he'll let you camp in the field. And that was his sense of adventure. So when he was a Rhodes Scholar and went over to Balliol College, he graduated there with a law degree in 1936 and left with his roommate on a tour of 40 countries. And I believe it was that knowledge that he brought back of the world, and the idea that investing only in the United States was incredibly arrogant. That why not diversify your investment overseas? Why not increase your supply of global bargains? When he came back from that trip, he had seen he had gone to the 1936 Olympics and seen the building contingency of Nazi soldiers. He thought that the U.S. would enter World War II. That led to his first trade, which of course was buying those 104 companies trading on U.S. stock exchanges on the eve of World War II. So I think extensive travel and his childhood, just being raised in that home with his mother, who had a very global perspective, influenced him greatly.
And I guess for value investors, the concept of buying at the point of maximum pessimism makes sense. It's just so difficult to do. I'm curious whether you can share with us any advice as to how you, or what you've learned over time. How do you deal with it? How do you really get into this emotional state to do that?
Yeah, it's very difficult to do. Humans aren't hardwired to do it. We tend to rely on a system in our brain which sends information very quickly to an area called the amygdala, which controls our emotional responses, fight or flight. Investors have a tendency to rely on this. Investors have a tendency to not do their own research. So when faced with a financial crisis or an ambiguous situation, they start looking to others to see what to do. This leads to hurting and contagion in the markets. So number one, you have to do your own research. You have to. That's the only way you'll have the fortitude to stay in an investment. If you're not going to do your own research, then you need to hire a good manager and stick with that manager. So I would also say that you can condition yourself to view market volatility as an opportunity as opposed to a setback. And the only way to do that is to put money to work in a very scary period and reap the benefits of that. That conditions your brain that instead of being fearful of those events, the next time one occurs, you're going to be anticipating the reward at the other end, and it becomes more comforting. Also, we keep a wish list of securities in our desk drawer. So did Uncle John. Companies that we love that aren't attractively priced at the moment. And during really scary periods in the market, we pull out that list. And instead of focusing on the money we've lost, we switch our train of thought and start focusing on the opportunities in our desk drawer. And that's a very, very powerful thing. You will not believe how that changes your perspective. When all of a sudden you pull out this list, it's your survival guide to a financial crisis. You put it together when you were thinking logically, when you weren't scared, and now you're going to start putting it to work. It's very calming.
Absolutely. No, I think you covered everything there.
So in a way, a checklist approach to investing.
Yeah.
And the conditioning and the experience that comes from, as Lauren described, getting the positive benefits.
Yeah, experience matters. I know I say that as a young person, and older people probably roll their eyes, but I have been investing for a long time for someone in my age group. And I can remember as a younger investor being very upset by market volatility, very upset when I had a drawdown in my fund. It made me physically ill. And now it just doesn't even faze me. I literally get excited when I see negative news headlines. They make me happy because I think, oh, look what a wonderful gift somebody has given me today. Now I can buy this stock for a low price, and I can compound my investors' money at a higher rate of return. And that has really just been through conditioning and experience.
And what would you say to skeptics who, maybe even cite the Ben Graham and say, well, that worked in the past, it doesn't work today. And then when it comes to the Templeton approach, what would you say to these skeptics who say, well, this was a different time?
Well, I say thank God that we all don't think the way I do, because it gives me the opportunity to make money. If everybody in the world was a value investor and everybody was chasing down the same bargains I was, and everybody was able to put money to work in a crisis or a panic situation, it really wouldn't leave me much room to manage my business and make money for my clients. So I don't put much stock into that. I think that, research shows that stocks are 14 times more volatile than their underlying fundamentals, based on your perspective, that's either 14 times more the Maalox you eat on an annual basis, or 14 times more the opportunity that you have to compound money at a higher rate of return. So volatility is great. Value investing still works for us, and thank goodness for the people that don't see it that way.
I would just add that the one constant, whether you're talking about tulips back in the 1600 or an internet bubble in 1999, it's human behavior, fear and greed. It's never been eliminated from the market, and I think value investors, because of their process, whether they explicitly say I want to take advantage of this or not, if they follow that process and purchase stocks when they get disconnected from their long-term fundamentals, their intrinsic value, they're always poised to exploit human behavior. And until human behavior is eliminated from the marketplace, that phenomenon is going to occur indefinitely.
Yeah, I loved how Uncle John used to say, I just seek to accommodate the sellers during a market panic. I'm doing my duty by just accommodating the sellers. And, in a raging bull market, I accommodate the buyers. So that's how he saw it, just being helpful, accommodating the sellers and accommodating the buyers.
And as you say, Uncle John, it's I guess those are some very big shoes to fill, and I'm just curious to understand a bit what goals you have for your firm and what drives you on a day-to-day basis.
Okay, our only goal for our firm is to compound our investors' money at the highest rate possible given an acceptable level of risk. That is the goal for the firm. And I really enjoy managing money, and I would be doing it with or without investors. I would be managing my capital. They are big shoes to fill, and I'm very careful not to speak on Uncle John's behalf. And Uncle John actually threw the baton to a lot of young people. I'm not the only person he gave a great opportunity to. Mark Halowesko was in his 20s when he was hand-selected by Sir John. Of course, Mark Halowesko ran the Templeton Growth Fund after Sir John retired. Marty Flanagan, Jeff Everett, Jane Siebels, they were all young people that were given this great opportunity from Uncle John. So I just try to learn as much as I can from his experiences, learn from other people's experiences. That's what I'm trying to do.
Yeah, I think as long as you're humble and and are well aware of the fact that you don't know everything and you'll continue to search for answers, you're protecting a sense of his legacy. So that's who he was. He always wanted to search for answers and was very turned off by people who appeared arrogant or pretended that they knew everything. So we just try to continue to learn and progress.
Well, on that note, Lauren and Scott, thank you so much for your time.